Good morning, everyone, and a very warm welcome to today's webinar, where we are going to be looking at investment planning. I am Sinemba Saliwani. I am part of Member Education Services at Alexander Forbes. I would just like that we maybe take just a minute to let everyone come into the session, and then we can start at 2 minutes past 10 because I see everyone is now coming in. So just 2 more minutes and then we are going to start with our webinar. Thank you. All right, so it is 2 minutes past 10 on my side. Without wasting any time, we are going to start with our webinar. I would also just like to mention that we do have Derek Manton, who's my colleague and also the regional executive, joining us on the line today. So if you have any questions, you're more than welcome to write them in the chat box. He'll be able to assist, but I will also be able to assist you with those questions once I'm done presenting, so at the end of the presentation. So feel free to engage with us and ask as many questions that you would like to, so that when you leave here today, you have a better understanding of what investment planning is all about. So I will start sharing my screen. Derek, if you can just confirm for me if it's also showing on your side.
I'll certainly do that, Sinabasa.
Thank you.
Your presentation is up, all clear.
Thank you very much, Derek. So I am going to switch off my video just so that it doesn't interrupt us while we are presenting. But as soon as I'm done, I'm going to switch it back on again. All right, so again, a very warm welcome to the webinar. Today, we are going to be looking at investment planning. Now, investment planning or just investment as a whole can be a very broad and also very complicated topic. So today we are going to be having a generic discussion around this topic. But should you need more information, you're more than welcome to contact us after this session. So should you need that individual one-on-one session, you're more than welcome to contact us. But today we're just going to touch on the basics of what investment planning is all about, and also what options do you have when it comes to investing, and where can you get that financial advice. Now, investment planning is also about trying to find that right balance between the risk that you are willing to take when it comes to achieving your financial goals. Now, determining what risk you are willing to take is very important because each and every person has different risk tolerance, and also our goals are also different. So it's important to find that right balance, because when you find that right balance, then you can decide on an investment strategy that is going to help you achieve those financial goals. Now, it can be a bit of a seesaw ride because, like I said, it's very complicated, which is why you need to sit down with a financial planner, have that one-on-one discussion so you can determine what is your risk appetite, what is your investment style, and what are your financial goals. Because once all of that is in place, it is then easier to find the strategy that is going to actually help you achieve those financial goals. So it can be a bit of a seesaw, but we are there to assist you in helping you achieve those financial goals. Now, your financial planner is regulated to follow a 6-step financial process, and these are the steps that they have to take. Firstly, it is establishing the investor's profile and goals. Thereafter, decide on asset allocation. So which assets can this investor be invested in based on the profile? Like I said, based on the goal and also based on the risk that the investor is willing to take. And then after that, it is selecting the asset manager and the portfolio to be invested in. Fourthly, then you determine the appropriate investment vehicle. So which one will be appropriate based on how long you're going to be investing for, and also what are your financial objectives. And then 5th step is the implementation process. And then lastly, you review annually to see how is the investment performing. Do you need to be switched to another portfolio? Because again, as we go on with our lives, our financial goals may change. For example, maybe when you started investing in that particular investment vehicle, you were married, but now you have divorced. Therefore, your financial goals have also changed, which is why it's important to have that annual review of your investments. So we're going to start unpacking each and every step of this financial process. Like I said, do engage with us in the chat box. If you have any questions, you're more than welcome to post them in the chat box. So firstly, let us start by looking at how do you establish the investor's profile and the goals. It is important to analyze your situation. It's important to also understand what type of investor are you, and also establish how much of a risk are you willing to take to be able to achieve those financial goals. So you would analyze the current income, the risk tolerance of the investor, what liabilities do they have, what expenses do they have on a monthly basis, the time horizon as well. How long are they going to be invested for? Are they going to be invested in a short period of time, or are they investing for long term? Because that will also determine what type of investment vehicle they should be invested in. Income requirements as well. Is it someone who's investing to get a regular income, or is it someone who's investing to get a lump sum after a particular period? That is also important because it determines where should you be invested. The tax profile also is very important because that is where you can actually try, or as the financial planner, you can then try and find investment vehicles that are going to be tax efficient based on that investor's tax profile. And then lastly, the assets. What assets does the investor have? So that is how you would establish the investor's profile. And then that is also where you would be able to gauge what is their risk tolerance, and also how long do they plan to be invested for. After that, it is deciding on the asset allocation. Now, the asset allocation is what will help you in achieving your financial goals that you have set for yourself. So which asset classes do you invest your money in, and also the time period that you are going to be investing for. Those two factors will ultimately determine what portfolio you are invested in, and also the returns on that particular portfolio. Now, each combination of asset classes will deliver a different return over time. Now, in the next slide, we are going to be analyzing the basic asset classes that you can be invested in. Firstly, we have your equities. Those are your growth asset classes. Those are the asset classes where more risk is taken when it comes to investing. For example, asset classes such as shares, that would fall under equities. And then you also have bonds. Now, the bonds, less risk is taken when it comes to investing, but it is also an option. And then you have your cash. Cash, again, less risk is taken. There usually is a guarantee when it comes to investing, but also the returns over a long period of time might be much lower, and they tend to not keep up with inflation. So as you can see, again, this is where the time horizon comes into play. It's very important because if you are going to be investing for a long term, then you might want to be invested in your equities and your property. And if you are investing for a shorter period, you might want to be in the cash and the bonds. But if you are going to be investing for a longer period and you are invested in cash, because less risk is taken and there's less return over a long period. And also the other risk is that it tends not to keep up with inflation. It means that you might not get the best from your investment. So that is where the time horizon comes in. And then you also have your property or alternatives. So you can invest internationally as well, or you can invest in property. Those are the basic asset classes that you can be invested in. Property as well, suitably for long-term period, and also it's a growth asset class. Now, each asset class has a specific role and it behaves differently to the other asset classes. Let us look at an example of how these asset classes would perform. We're going to be looking at shares, property, bonds, and cash. And then we are also going to be analyzing the inflation. The reason why we look at inflation is because it is very important and it also plays a vital role when it comes to investing. I'll make a very simple example that will be easy for everyone to understand. In the year 2000, to get yourself a loaf of bread, you would pay around 5 rands. But today, to get yourself a loaf of bread, you have to pay around 15 rands. So prices are always increasing, and that increase in price is called inflation. Now, it's important to ensure that the return on your investment is at least keeping up with that inflation, or actually performing above inflation, so that your money does not lose its purchasing power and it also does not lose its value, because it is without a doubt that what you can purchase today with 100 rands is totally different to what you'll be able to purchase with 100 rands in 10 or 15 years time, because of that increase in prices. So that is why we always look at the return, but also compare that to the inflation over that period of time. Now we're going to be looking at the value of 100 rands that is invested for 40 years in all these different basic asset classes that we just looked at. Now these are the returns at the end of May 2021. Now this 100 rands was invested in May 1981 up until May 2021. The first line on that graph, which is highlighted in orange, that is your property. And as you can see, the return was 15.8%. Now, as you can see with property, the line is not a straightforward line. There is a lot of fluctuation. There's a lot of up and down. Now, like I said, property is a growth asset class. More risk is taken, more exposure to the market when you are invested in property, which is why you would see those fluctuations. But if you look properly, you will see that it started here, but it's definitely at a very high point from where it started. So with property, yes, there are fluctuations, yes, there are ups and downs, but over the long term, you get the highest return. Then below that, you are going to be looking at the shares. Now for the shares, the return was 16.4%. Again, fluctuation because it's a growth asset class, more exposure to the markets and more risk also taken. Although there are fluctuations over the long term, it's definitely higher than where it started, and also it gives you another high return. Now, if you're looking at your bond and your cash, which is the two lines below that, if you're looking at your bond and your cash, like I said, less risk is taken with those asset classes. And there's usually a guarantee when it comes to investing, less exposure to the markets as well. As you can see, there's less fluctuation, less ups and downs. But also, if you're comparing it to the shares and the property, over the long term, it definitely gives you much lower returns. And like I said, this is where the time horizon comes into play. This is where it's important to understand how long are you going to be invested for, so you can be allocated in the right asset classes and also the right portfolio. Now, if we compare the inflation over that period. As you can see, over that period, inflation was 8.4%. Now, cash did surpass inflation because it was 11.4%, but that's still close to that 8.4. And then bonds as well, it was 12.4%. But if you look at shares and property over that period, their return was way above inflation. So like I said, it's important to always look at the inflation and also look at the returns on your investment, because you don't want your money to be losing its purchasing power, and you also don't want to be invested in a portfolio or in asset classes that are not giving you the best return. But that is just an example, or a simple example, to show you how the different asset classes perform relative to each other. Now we are going to be moving on to the third step of that financial planning process or investment planning process, and that is selecting the asset managers and portfolios. Now, firstly, I will determine what an asset manager is, or define what an asset manager is. Now, an asset manager is, or an asset manager will determine what investment to make or what investments to avoid to be able to meet the client objectives within the specified limits or the specified risk that can be taken. That is what an asset manager is in simple terms. Now, there's a large choice of asset managers and investment portfolios that are available to you as the investor. You can choose between a single fund manager, or you can choose a multi-manager or multi-fund manager, or you can also have a combination of the single fund manager or a multi-fund manager. Now, Alexander Forbes is a multi-fund manager. Let me start by defining a single fund manager. A single fund manager would, for example, be Allan Gray or Coronation. If you go and invest with Allan Gray, you only invest in Allan Gray portfolios. If you're investing with Coronation, you only invest in Coronation portfolios. That is what a single fund manager is. But with a multi-fund manager, you can basically combine all those different single fund managers in one investment. Now, we can say that is simply not putting all your eggs in one basket, diversifying, which is very important when it comes to investing. So you can combine all those different single managers in one investment portfolio. Now, as Alexander Forbes, we are multi-fund managers. But as an investor, you can choose, do you want a single fund manager or do you want a multi-fund manager? Now, the multi-fund manager approach is usually recommended because, like I said, you are not putting all your eggs in one basket. You have different fund managers that are looking after your investment. So in the next few slides, or in the next slide, we are going to be looking at how important it is to actually diversify when it comes to fund managers, so that should one of the fund managers you have selected not perform as well as predicted, you at least have other fund managers that can balance that out, or that can actually make up for that negative performance. But in simple terms, that is what an asset manager is. And also you can combine, or you can choose between a single fund or a multi-fund manager. Now, firstly, let us look what are the type of risks that you can be exposed to when you are investing. There's asset class risk, where you can maybe be invested in an asset class that is not appropriate for your investment profile or your investment style, or also your risk tolerance. Also, the risk of only investing locally, and the risk of also investing internationally, because what happens if they don't perform as well as predicted. Also, the risk of only selecting a fund manager that is not appropriate again for your investment style. That will mean that you won't get the best return from your investment. And also the benchmark. Now, the benchmark is basically the target for your investment. Now, there is a risk that you might not meet that target. Other risks that you can be exposed to when you are investing, there's capital loss. If there are negative returns, you may suffer capital loss. There's also inflation risk, and that is what we discussed earlier, which is the risk that your money might not, or your returns might not keep up with inflation. There's currency risk as well. There's liquidity risk as well. But now the liquidity risk is something that can actually be managed if that first step in that financial planning process is done adequately. And what I mean by that is if you determine what exactly